Today I'm going to discuss the different types of mortgages that are out there. Okay, I'm going to start off with FHA. If this is residential we're talking about now. What are the advantages of an FHA loan? First of all, FHA does not give loans. All they do is guarantee loans for the bank. So the bank's actually going to give you the loan. It's just going to be an FHA type loan. You don't pay the bank back, the government will pay the bank back. Okay, one of the advantages is there's a small down payment. It's usually 3.5% to somewhere along 7%. There's very easy qualifying. They will lend on 1 to 4 units. Minor credit problems are okay. Major credit problems are not okay. If you have a late payment or something on a credit card, you can write them a letter, write a little letter and explain that away. Assumable loans. FHA loans can be assumable. Okay, you now have to get them. They used to be totally assumable with no qualifying. Now you have to send in paperwork to qualify for it, but they are assumable. You might not have to go out and get a new loan. Now, what kind of programs do they have? They have 2 basic programs. They got a fixed rate program and they got an adjustable rate program. Right now, I would suggest taking the fixed rate because the rates are so low. Next type of loan I'm going to talk about is a VA loan. Now, again, the VA does not give loans either. They guarantee loans from the bank. You'll get it from a regular bank. There's the VA guarantees loans. VA loan you get with no down payment. They have what they call VA no-no. And that's no down payment at all. All the money has to be put up, all the closing costs have to be put up by the seller of the property. So actually you're buying the property if you're a veteran with no money at all out of your pocket. You do have a monthly payment though in 30 days. Again, 1 to 4 units on those. Easy qualifying again, just like the FHA. Now, VA will allow a second trust deed. Let's say, for instance, you actually do put money down, because you're allowed to put money down, and you put down 10%, and you only go out and get a 70% loan to value. In that case, you can put a second on there. The seller can carry back a second, or you can get a private second and put it on there. But FHA does not allow seconds, and VA does. Okay, what kind of programs do they have? They have the fixed rate programs also and the adjustable rate programs. And the VA loans are also assumable. That's good. Okay, let's go over here and discuss conventional loans. This is what most loans are, conventional loans. And they have a variety of programs. I mean, literally a variety. It's like going into a grocery store and going down the cereal aisle and seeing 50 different types of cereal. Same idea on the programs here. You can take a fixed rate loan, no problem. Those are good now. You can get an adjustable rate loans. Now, how do adjustable rates? When they become adjusting time, they are tied to an index with a margin, and they have caps. What I mean by caps is you can only raise it maybe 1 or 2% per year, and maybe only 5 or 6% over the lifetime of the loan. That's what I mean by a cap. Okay, some of the loans are convertible. You can start them out as a adjustable rate, and you can switch them into a fixed rate at a certain period of time. Some are assumable, some are not assumable. Actually, most are not assumable, but there are some that you can assume. But sometimes, if you have a higher interest rate on there, and it's a non-assumable loan, let's say the going rate today is 4%, but you got a 7% on there. And for whatever reason you want to keep that loan on there, you can go to the bank and they might let you take it over, because if they get the money back at 7%, there's no way they can lend it back out at 7%. They'd have to lend it back out at 4%. So they might want you to take over that note. 1 to 4 units is what they do. Actually, you can get conventional loans for commercial properties, apartment buildings, etc. also. Owner and non-owner occupied. I forgot to mention we were talking about VA and FHA. Those are owner-occupied loans. Okay, in this case, you can get a non-owner-occupied loan. You don't have to live in it. And you can get, they also have PMI. PMI stands for Private Mortgage Insurance. And with private mortgage insurance, you can go over 80%. If it's under 80%, then you don't need PMI. But if it's over 80%, if you're getting a 90% loan, you're going to need PMI. Now, we're coming over to the next set is owner financing. I could give a whole dissertation on owner financing, but I'm not going to do that today. That'll be a whole nother video. Okay, owner financing are easy to negotiate. You're dealing with the owner one-on-one. Anything goes. This isn't a bank. Okay, the seller is the lender in this case. These are sometimes assumable. Some of the private owners would like to collect money for 15, 20 years. Others, you know, would want their money back as soon as you go out and refi. Okay. You got interest rates, payment schedules, and due dates are easily negotiable because you're sitting down and you're dealing one-on-one with a person. So you can work anything out, which is a lot different than sitting down and working with a bank who won't even listen to you. Okay. And usually there are no points on the loan. Okay, when you go into the bank's going to charge you points and fees to take the loan out. 95% of the time on an owner will carry, there are none of those fees. The owners are not even thinking about it, and if I'm a buyer, I don't bring them up. Okay, although if I'm a seller and I'm carrying the note back, which I have done, I might charge you a point. But that's me, not most people. Okay, you have no appraisal. You don't need to have an appraisal. Now, if you're a seller, you might want to get an appraisal, but you do not have to get an appraisal because those are usually required by the bank loans. And you can also do a substitution of collateral. We used to call this walking the note. And for instance, you might want to take the note off property A and put it on property B. And you might have plenty of equity to do that. And the seller will be amenable to do that. If you do that, you can take all the liens off of one property, put them on another property. Then you got a whole property that can go and refi and pull out a whole bunch of money if you choose to do that, or you can just own it free and clear. There's different ways to go on that. But that's what a substitution of collateral is. You can walk the note from property to property. Okay, real quickly, that's the type of loans that are out there. There are other loans. These are the major loans. I'm not going to get into any different other kind of loans at the moment. But if you need to know more information, go up to my YouTube channel. Hashtag Floyd Loans. Make sure you put the hashtag in there. Also, when you're there, make sure you subscribe. There's a red button. Hit the subscribe button. Don't feel free to hit the share. Make any comments, the like button, whatever you want to do. Go to Facebook at Floyd Loans, Twitter at Floyd Loans. If you need to email me for any reason, you can reach me at floyd@woodrumfinancial.com.